Money comes in all ways, when you are aligned with your gifts and talents, serving the way you were made. This is scientifically proven. And when you test the theory, money just flows and it makes us feel calm, peaceful, and helps us work towards that financial freedom. These are the conversations we are having in The Smell of Money, a community on School where we think about how we want our relationship with money to be. Plus, there's cash flow quickies to give you immediate wins. Members are saving $500 to $2,000 just by being aware of their money. Come join us. The link is in the description.
If you're tired of feeling shame about past financial decisions, worried you'll never achieve financial stability, and ready for a clear plan to take control of your money and experience true financial freedom, you're in the right place. Hey, I'm Lisa, wealth activator, independent insurance broker, and your guide to rewriting your money story. I learned the secret to creating financial freedom and stability after divorce, and I'm ready to share it with you. If you're ready for steady, stress-free income, clarity with your money, and the confidence to spend without guilt, grab your favorite essential oil, take a deep breath, and let's sniff our way through the smell of money. Hey everyone, welcome back to the episode of iDateMoney. Today's guest is Jay Patel. He is a global real estate investor with 25 plus years of experience. He has built businesses across rehabs, commercial deals, and prop tech. I know prop tech has got your ears up, so go grab a cup of coffee and come in and listen in. Thank you so much for being here, Jay. Tell us more about your journey. Where were you before you started the real estate? What was your journey like before you had money?
Wow. Well, that's kind of a loaded question. I can answer that in a number of ways. But before we start, I wanted to say, Lisa, first off, thank you for having me on. I have listened to a few of your shows, and I love the content you're putting out there, especially some of the guests. I think they share a lot of wisdom, and I really enjoy the previous shows that I've watched. As far as, doing what I do, where I come from, I didn't start in real estate. My journey actually began in the markets. Right out of college, I became a stockbroker. And, I loved the market. I saw my parents doing it and other friends. And I said, hey, this is something I wanted to do. So I went and I actually did well initially. I got right from brokerage. I got a number of promotions. I worked my way into the trading department. And by matter of circumstances, within a matter of a year to year and a half, I was not only in the trading department, but I was actually running the trading department. And that's kind of a big feat for somebody who's only in their 20s. That was a big deal at the time. And also because I was fortunate, I had some great trades and picked up on my mentors' advice and learned the lessons. That's one of the biggest things I'll tell people, especially your listeners, is that don't go at it alone. If you find somebody who's really good and work with them to guide you in accomplishing your goal, number one, it's going to save you a significant amount of time. Two, the headache. So, and of course, money. If you end up making mistakes, it costs you a lot of money. So really working with somebody is huge. But what I did was I started out in trading, did really well, ultimately got to a point where I managed a small hedge fund and I also owned a brokerage company. And then it happened, as happens with many people. Sometimes you think you're invincible because you really haven't taken a big hit. And, that's the worst thing that can happen. I think we learn our biggest lessons when we have a loss. Right? I mean, when you win, it's like, oh, no big deal. You just move on. It's assumed that it was kind of expected. But when you lost, you actually look back and reflect and say, hey, what did I do? What could I have done different? And you learn your best lessons. And in 2001, when the attacks happened on September 11th, I took a hit for almost $2.5 million that year. And as a 30-year-old, that's a significant amount of capital. It really tested not just me, but my family, my wife, our relationship, everything, because we went from up here to right here. It was something that was almost outside of our control because even though we were doing well, my firm was doing well, my fund was doing well, there's an outside circumstance that can suddenly happen and overnight change everything, right? The markets were closed for a number of days. When they finally opened, it opened down over 1,000 points. I had a lot of overseas money. And at that time, I don't know if you remember, but there was a lot of uncertainty. We didn't know what was going to happen. We didn't know if there's going to be additional attacks. And so what happened on a global level is these people who had invested with us from Europe, they're like, hey, we want our money out. We don't know what's happening there. We feel more safe if we take our money out. If you were in their shoes, you might have done the same thing and say, listen, we'll take a 10, 15, 20% loss, whatever that case might be. I want to take my money out. But by doing that, we had to then absorb even a greater loss because now we're selling into that downward pressure to unload the positions that we had. And I kept telling them, guys, when people are selling and everything, and everyone's running for the hills is when we should be running in. Because I'm more of a contrarian. That's where the opportunities are. And the same thing holds true in real estate, by the way. But I digress. So we happened to take a big hit, had to, look back and say, okay, what are we going to do? Where are we going to go from here? I took a year off. And one thing that had always worked for me, and this is, like I said, I was only 30, 31. In the previous 5, 6 years, real estate had always worked really well for me. So what I did was I then decided to get more active in real estate. So for the last 25 years, I've been much more, almost I would say full time, but in multiple different capacities. And you mentioned like prop tech. So in the States, like today, as I mentioned earlier before we got on the podcast, I'm actually overseas. I'm in Bombay right now. Prior to this, I was in Vietnam. I went from Ho Chi Minh to Bombay, and I'm going to go from here to Bangkok, and then finally back to Chicago, which is my hometown. But one of the things that we did in prop tech is we look for opportunities, and sometimes you don't always have to look; it just comes to you because of the space that you're in. You keep your eyes open, etc., and you see an amazing opportunity. What am I talking about? Well, in America, we're very blessed that we have systems that provide really good, accurate data, right? What am I talking about? MLS. So when you have an MLS system, I think most people know what that is. That's a system that all the agents in America use, and it aggregates all the property listings in your local market. What that does is, because it's a central database, anyone can go in there and you just put in your query, says, hey, I'm looking for XYZ, and then boom, within seconds you have it. Well, believe it or not, 90% of the world does not have that. So we saw this opportunity, and at that time, after about 3, 4 months of due diligence, research, feasibility tests, we decided we're going to build it. So the past 10, 11 years, we've built India's MLS system, and now we're taking it to the Philippines. That's a massive project. Unfortunately, we haven't made any money on that yet, but we're growing because it's a startup. And now we've got over 12,000 users, looking to get up to 100,000 users, et cetera. And then we're going global with that. What I started doing in 2001 is I started getting more and more into real estate. So I started getting into multifamily. We did a lot of rehabs, as you mentioned earlier. We did some fix and flips. We love both short-term and long-term types of investing in terms of real estate. So that's our journey. And so since 2001, I've really been focused much more on real estate. And thank God, if I had some wood here, I'd knock on wood because, we've been a little blessed that even though you may make some bad bets, the good thing about real estate is that if you have a long-term view and if you buy right, you won't lose. I mean, you generally won't lose because, real estate does appreciate. And by the way, when we invest in real estate, we're not looking at making money based on the appreciation. I feel like a lot of people that invest in real estate, if they're banking on appreciation, they're investing in real estate the wrong way. That's number one. When we go into a deal, we already know within a fairly good range approximately how much money we're going to make. And you say, how is that possible? I'll give you a simple example. Today, I manage a fund. It's called PropTex. And PropTex has 3 different verticals. One of those verticals focuses on more shorter term transactions. So what do I mean by that? We buy foreclosure properties, short sale properties, tax deed properties. So these are 3 different types of assets that we'll acquire. And those assets, we're buying them well below market value. Now, the beauty, as I mentioned in America, when we have a plethora of data, like from the MLS, or even if you go to Zillow, you can see what your homes in your neighborhood are worth, right? And you have a general idea. So when I go and find a foreclosure opportunity, I already have an idea that that home, when it's updated, approximately what it's going to be worth, give or take, 3 to 5%, even not that much, sometimes only 1 to 2%. But the point I'm making is we have a very good idea what that property is going to be worth. Now, if I can buy that property 20 or 30% below that number, it's a win, right? I mean, at the end of that, you can't do that in the stock market. In the stock market, you can't say, well, I know that this stock is actually going to be worth here. There's no guarantee. There's no comps for stocks like that. So when you buy a stock, you're hoping it'll go up. You're hoping that it will achieve maybe a 10, 15, 20, 30%, whatever that number is. But when I buy a property and I buy a foreclosure or a short sale, I already know that if it's $1 million property and I'm paying $700,000, I already have a $300,000 spread on that. So even if I spend $100,000 to update or fix it up, and improve it, I've got a $200,000 potential profit. And you say, is that really worth it? You're only going to make, 200,000, you're buying $1 million property. But what people fail to understand or they don't recognize is I didn't put $1 million of my own cash into that deal. More often than not, I'm getting an 80% loan on that. So I may have bought that property by only investing 150, 160,000. Let's say it's even 200,000. I invest 200,000, but I make 200,000. I made 100% of my money. So always you got to assess your profit based on the amount that you invested, not just, hey, it's a 20%, increase. So long story short, our journey started with all these different types of assets. We love it today because now within the fund, we have a short-term side of it. We have a long-term portfolio. One of the biggest things that we're investing in on the long-term side are residential assisted living. That is a tremendous opportunity today. If your listeners are looking for one area to invest in potentially when it comes to real estate, if they're not excited about, say, individual single family homes, because I personally don't like managing tenants and things like that, or even what we used to do in multifamily, it's not the same today. But when I look at the returns that we're getting in residential assisted living, it's phenomenal. It's like real estate on steroids. I love it. So that's one area that I would recommend. Another thing we've done is mobile homes, storage centers. These are good cash flow opportunities. And so what I like to do is, especially when it comes to like retirement planning, or if I want to make sure that I have enough income, because in retirement, it's not about appreciation. It's about making sure you have enough income that can support your lifestyle so that you're not having to compromise or you're not having to change your lifestyle the moment that check stops or the moment you decide you're going to retire. We want to make sure that whatever lifestyle you've had, whether it's taking a couple of trips a year, going to nice fancy restaurants, or whatever the case might be, you shouldn't have to change that just because now you're retired, because you're afraid you may not have enough or you're afraid of running out of money. So PropTex is designed to ensure that, we basically sit down with investors and go over initially when they decide to come in and say, okay, where are you? What do you need when you're looking to retire? Do you have what it would take, and can we help you achieve that? And then so we work kind of backwards and say, okay, how much do you really need on a monthly basis? So if they say, for example, I need 10,000, 12,000, and we take a look at what they have and say, yeah, it's definitely possible, because what we're going to give you, what we're capable of delivering is 11% on an annual basis. And some might say, hey, that's not so sexy. What's 11%? But 11% actually beats the S&P 500. So we're beating the market without the crazy volatility you're going to get in the market. And so you can sleep at night knowing that it's backed by hard, tangible real estate, not something that could potentially go down 50% tomorrow. So I'm not a big fan of buying individual stocks. I love
Mhm.
something that's a little bit more predictable. And I gave you the story about what happened to me in 2001. That was unpredictable. We don't know what's going to happen. Now, when you're younger, it's fine. You can take that chance. But when you're 54 like I am, or 55, you don't have the ability. You don't want to be living in this yo-yo situation. So if your portfolio takes a hit of 10 or 20%, that's a hard, thing to come back from, because we don't have that large amount of time to be able to recover that. So these are things that are important. I like predictability.
And predictability is comforting. It gives you that security. And I know a lot of our listeners like the security, like that. They want financial freedom with security, and taking risk is really a challenge for some of them because we work so hard for our money, and, investing in something that's they're not familiar with is really challenging, especially when it's new in the industry, right? So when you think about investing and teaching others how to invest in real estate, you had mentioned assisted living. I know in Florida, that's where I'm living, we have assisted living homes going up where private investors are purchasing them. And then, the ROI is amazing because, you get 4 or 5 residents in these homes. And then, of course, you have all the state regulation with the medical care, but the net profit is very generous.
You mentioned a very important point. Assisted living is great. The cash flow is great. But if somebody says, okay, Jay, I definitely am going to do this, I would still say don't go at it alone. Find somebody who's done it. Find a company that can help you, mentor you, and guide you. Because if you buy a home, let's say, and you want to convert it to an assisted living, and you're thinking about 4, 5, 6 residents, based on the research that we've done and from our own experience, I would advise against that. And the reason I'm saying it is, you need to take advantage of economies of scale when you set this up. And the magic number for us that we've seen is to have at least 10 to 12 guests. Each state is different, by the way. So some states, they may not allow 16. But if you can get 16 residents, you're going to be in a very, very strong cash flow situation. I've seen homes that, have 12 to 16 residents are turning over on a net cash flow, profitability cash flow of about 40, almost 50,000 a month, and that's after debt service. So that's your net. It's unbelievable, right? Obviously, it's not a small investment. But the point is, like you said, many investors will invest into it or they come together and maybe invest into it. I would say if they like that, but they don't want to deal with the management headache, then something they can look at is someone like us because we invest in them. We actually set them up so they can get the benefit of the investment without having the headache of the management. And the other thing is that's important when you're looking at retirement is diversification. Because if you're buying or investing into one asset, and hypothetically, let's say it's mismanaged or the location's not great and it doesn't provide the type of returns you're looking for, you got all your eggs in that one basket.
Right.
Whereas if you're investing in, say, in a fund that's diversified across multiple assets, even if one doesn't perform at the level you're hoping for, the others can make it up. Right. And so that's important, especially. So when I say is like for someone who is looking towards retirement or is already retired, I feel diversification is of paramount importance. Obviously, capital preservation is the number one important because you don't want anything to go down. You want to preserve the level that you're at, and most importantly, is now the second part is making sure you're exceeding inflation and your overall expenses on a annual basis. So you want to be able to make enough income that can support your lifestyle. So
Mm-hmm.
at the end of the day, like right now, you've already seen based on current events, inflation's not doing well. So if inflation goes up and it continues to go up, especially if this war continues and oil prices continue to go up and inflation takes off, our dollar is not going to pull as much as it does today. It's super important to be able to be in an investment that can at least outpace that. So even if people are looking at it, and I think real estate is a great hedge, by the way, because when
Mm-hmm.
things go up, real estate values are also going up. So it's actually works as a great hedge. If you want to diversify, some other things you can look at are potentially like gold, silver, precious metals. They can be another good investment. Unfortunately, the market isn't always a great investment when there's high inflation, because then, of course, the
Right.
rates are going up as well.
Right. Yeah. And it's so important just to understand the base foundation of all that. So, when people are investing, they understand the difference between the stock, the real estate, the gold, the silver. A lot of people have different viewpoints on that. So, do you coach people through this process or tell us about what you do specifically to help people?
So I have a company where we help people who want to flip homes. We actually coach them. It's actually called a flip firm. It's a whole separate entity. It really depends on the individual. Like say if you're in your 50s like I am and you're looking at if you're looking towards retirement, you may not want to be doing the fix and flip. You may not, you know what I'm saying? Like everybody's different. So I would say first and foremost, yeah, it's a great question. I mean, can we coach? I would say that if anyone is at a point where they say, okay, I need to assess where I'm at and where I'm going to be. I want to work backwards, right? So I'm going to be retiring in 5 to 7 years, 10 years. I'm not saying I'm a financial planner, but what I can do for you is sit down and take a look at your portfolio and say, okay, where you're at today, can you get to the number you want to? We've got a couple of proprietary like calculators, spreadsheets that I can give you and or your listeners, and they can plug in the numbers and they can see, okay, how far am I from where I want to be? Right. And can I achieve the goal that I want to achieve? And we can help, basically give you a real clear picture of where you're at. And it's not, people may be surprised. They might say, oh my goodness, I only have hypothetically, $400,000 or $500,000 saved or a couple $100,000 saved. I have it in my IRA or I have it in my 401k. That won't be nearly enough. That's what they're thinking. Two things. Number one variable is what's your age, meaning how much time do you have between now and retirement. If you have X number of years, now let's figure out where do you need to be. So if you have 200 and you need to get to say hypothetically 500 or 1,000 or a million or whatever that number is, can we get there? And how can we do it without risking a significant amount, right? So it's making sure you have capital preservation. What kind of assets can actually deliver you the kind of return you need to be able to get there? And then let's manage your expectations. It's not like to say, I'm not saying that if somebody had $100,000, they need to get to $1 million. It's going to be possible. We got to be realistic. So can we get there? And so we'll help you understand that through our spreadsheets and by just plugging in the numbers, because that will tell you, okay, you've got 10 years before you want to retire. This is where you're at. This is realistically where you can be at. And we can show you 2 or 3 different ways to get there. So that's something we would do for people. We don't charge anything for that. And then, of course, if they feel like, hey, this is something that's of value and we like the service that they're providing, we like the fund, then they also have the option of obviously coming in and getting involved with us with the fund. If they do want to do flips, then that's something else I can actually help them with. Then I would direct them towards the Flip Firm, which is a company that we own. And that company, by the way, it's unique. It's not like your typical flipping company or companies that teach people how to flip. What do I mean by that? People that come in and actually work with us at the Flip Firm, we fund them 100%. That's like unheard of. if their job is, of course, to find the deal that qualifies in our with our program, as long as it meets our criteria, what we do is we partner with the flipper. So essentially, we're the financing partner, they are the operating partner. So it allows us to then scale our short-term flipping business, because if I'm going to do it individually, I might only be able to do, 5 to 10 flips a year. But by me doing it and partnering with people all across the country, I could be having 30, 40, or 50 flips going on at the same time. The one thing that we do have is the capital, but we don't have boots on the ground in every city. So what this does is it allows us to partner with people who are, let's say you might be in Kansas. By the way, speaking of which, we're doing a property there now. We've got deals going on in Florida. We've got some in Texas. But the point is, if somebody's interested, they find a great opportunity, but they don't have the capital, they could partner with us. And that's something that we can show them how they can get the capital that they need, because we would provide it. They'll be able to do a flip with no money out of their own pocket. So they would have to have decent credit, because we help them get the initial hard money loan. And then we provide what's called gap capital. So when you buy a property, you might get a loan for 80 or 85%. You still have to come out of pocket, your 10 to 15% out of your own pocket, right? So we provide that. And then, of course, the hard money lender is also going to give you 100% of the rehab. So technically, the investor is able to go into the deal with no money out of their pocket, but they do have a partner. So as opposed to them doing it on their own, the one side is the benefit is you don't have to come out of pocket any money. The downside is you're going to have a partner in the deal. I see that as a positive, because you've got somebody who's done a number of flips before. It's actually goes back to the whole mentor concept, right? You've got somebody that you're partnering with that's done it, that can help you avoid the problems. As long as you find and follow the guidelines, you should do well. And it'll help you, we'll help you stay out of the trouble. One of the other things that we do that nobody that I know of in the industry does is, especially for the first flip, let's say you join us in our program, it's your first flip you're doing. Every one of those flips that you're doing, the first one, for each one of our clients, I personally travel and spend a day with them. So the first half the day, we're meeting with the contractors. This is after the property's under contract, before we close. So I spend the day with them. So the first half the day, we meet with contractors, walk the property, look at all their bids, and then we break for lunch, go over the numbers, make sure it's in line with the scope of work. Then in the afternoon, we go and look at the comps. And the purpose of that is to make sure, because many new flippers, they don't realize they're so excited. They want to make this thing the most beautiful home in the street, in the neighborhood. But you don't have to do that. And sometimes, because what happens is you may overspend, and you're never going to get that return back, because that market's not going to support the value that you're going to, the price you're going to charge. So these are things that we help them avoid, and we make sure we know what the comps are, so that you're actually delivering or building or finishing a product that's designed, that's going to sell quickly in that market. You don't want to be priced outside of the market, because the buyers in that market are only, say, for example, in the $200,000 to $300,000 range. But in order for you to make money, because you spent so much on this rehab, you might have to price it at $350,000. That's going to price you outside the market. So there's a lot of little things like that too. We also show them how to get properly staged and sold, but that's a whole separate business. So that's the flip firm. So what I do, you asked earlier, is my primary business today, Lisa, is I love managing the fund, which is PropTech. I like helping people make sure that, people that are my peers. How did this whole fund start? It started because I started helping a few friends. It's like, they said the issue is when you're helping people individually, there's only so many you can help, right? Meaning I can work with. So once I did it for 3 or 4 people, and then others say, hey, Jay, I want you to help me with this. I said, number one, it's impossible for me to be able to do this. I don't have the time, because I'm doing other things too. So now they invested in, we said, okay, let's create a fund. You guys put it all in your capital in, because that way now, if John gets a 10% or 20% return, and Andrew is also going to 10 or 20% return. It's not like one's going to get a 15%, other one's going to get 10, other one's going to 30, because now everyone's a part of that one pool in the fund. And it's easier for me, because now I can manage that one fund rather than having to manage 10, 20, 30 people. So the fund started out like that, where people just said, hey, Jay, we see what you've done. You've been successful. Can you help me? So we started helping individual, like literally my peers. I'm talking about people I went to college with. And then I just decided, hey, this isn't scalable, number one. And it's taken up too much of my time. So that's why we ended up setting up the fund. But it's actually great for even other people who are pre-retirees or retired, because they can get a nice solid 11% on a per annum basis. And by the way, the thing about our fund is, number one, we don't make a dime until the investor gets their 11% first. Second, there are no management fees. So what that's called, by the way, it's a pref, 11% pref. So it's an 11% preferred return, and it's an 11% cumulative preferred return, which means that you get your 11 before we, Jay and his team, make any money. Number two, there are no management fees. So it's not like even if you get 11%, you're going to have to pay a 1% management fee. There are no management fees. Number three, should it happen that one year, for any reason, maybe it's at 10%, the following year we have to give you 12 before we earn anything. So it's a cumulative. So if you stay in the fund for 3 or 4 years, you should have 11, 11, 11, like, you should have at least that for each year. So that's essentially how it's set up. But we have multiple different verticals. There's no massive lockup period, which is great. Most real estate investments, people are afraid because they tend to have long lockups. And sometimes people get intimidated because they haven't done it. I'm sure, because I know your listeners are fairly successful, or you said like, maybe mompreneurs, right? You mentioned, and they've been successful in their, maybe in the corporate world. And I know because I have many friends that are like that, but they're intimidated by real estate. They don't know. They feel like it's this big complex thing. And believe it or not, it's not. It's like, I wouldn't know about their space, like whatever they're doing, it would seem very, intimidating to me. But at the same token, they might say, hey, this is really not that hard because they've been doing it. Same way with real estate. If you just spend some time with someone who really, number one, who's an expert in it, who knows what it takes, and educate yourself, it's really not that difficult. Going back again, I keep harping on the whole getting a good, strong mentor because they can keep you out of trouble and save you money.
Right. A mentor is so important in all aspects of our life.
Mm-hmm.
So how would someone go about investing in what is it, a I lost the...
It's PropTex. PropTex is the name of the fund. So we came up with our own word, say, wait, what is PropTex? Well, it's almost like so prop is short for property. T is short for technology because we do both property and technology, but also we're taking advantage of AI now, really incorporating it into our models. And then EX is just our expertise. So property, technology, and expertise combined. So we created PropTex. Our PropTex fund number one is it's what we call our income advantage fund. And that's one it's designed to, generate 11% on a consistent annual basis. If hypothetically somebody has, and this is one thing I wanted to touch on because people don't really fully understand always the power of compounding. If someone has $500,000 in a IRA, a 401k, and savings account, etc., and if they were to invest that and have a 10-year outlook, at 11%, a 500,000 becomes almost 1.5. So let's say 1.43 or 3. If they then say, okay, I want to now convert from a Class B to a Class A. Say, what does that mean? So in our fund, we have two different classes. One is that's compounded, so you're not withdrawing. And the other one is with you when you're getting quarterly distribution, so it's not compounding. But you can switch from B to A. So let's say when you're retired and you want the income, you say, I want to switch over to the A. So when you do that, you're essentially, if you have a portfolio that now has grown to 1.4, that means you'd be getting about $13,700 a month in terms of cash flow. I mean, I don't know about you, but I know most people, would be able to at least be able to live fairly comfortably with that amount, assuming that they don't have a really, really lavish lifestyle. So that's our goal, is to make sure that you can get into a position where you're comfortable, not have to compromise on what you want to be able to do, etc., and then be able to have a nice lifestyle. And then at the same time, the biggest thing is the money that you put in is not being depleted. One of the biggest mistakes that I've seen that even financial planners and that they advise people is you live on what they call the 4% rule. 4% rule is where you're basically depleting, you're drawing down 4%. Well, hypothetically, if you had $1 million, 4% is only 40,000. I mean, 40,000 nowadays, it's not going to go very far. I mean, just think about it this way. We talked about residential assisted living. What happens if, and no one's invincible. Let's say we get to an age where 70, 75, and we need assisted care, right? The cost of an individual, one person in a residential assisted living, for example, in the state of Illinois, it's $5,700 average. Now, ours are like more higher end or nicer, more like a boutique. The average on those are closer to $7,000-8,000 per person per month. That means if you were getting only $40,000, you'd last 5 months. You wouldn't have enough income to do that. So it's important to make sure that whatever you're invested in has enough income, passive income, and it's not depleting your savings, because now should anything happen to you, that money's going to go to your heirs, right? Whether it's your kids, your grandkids, etc. So these are things that we kind of focus on. It's not sexy, but it's important. And this is something that you really got to do.
Yeah. And it's very important to know that, when you're planning on retirement, no one ever plans on moving into a nursing home or assisted living. So they think their money's going to last forever. And I know I retired from the Social Security Administration after a 30-year career, and I saw a lot of people quickly deplete their funds because, they didn't even have long-term care insurance back then. But actually looking at that to see if that's a good factor to put in to the portfolio while you're thinking about, the standard is the 4%. As you mentioned, the cost of living has increased
Yeah.
dramatically. I'm originally from upstate New York, and my mother-in-law is in a nursing home, $20,000 a month. So
Wow.
it's very expensive,
Yeah.
and she needs full care because she has Alzheimer's. But when you think about it, like the assisted livings run around $6,000 a month.
It's 6 to
That's a
8,
big,
and by the way, if it's memory care, it's 10 to 12,000. So like
yeah,
if you're dementia or Alzheimer's or something like that, if you look at the numbers, just look at the statistics and the number of people that it happens to. I'm not saying it's going to happen to you or me, but we got to be prepared should it happen and
yeah,
make sure we have enough.
yeah. And protecting it and investing in things that are very supportive of our goals is really important. So tell us, what's the best way for our audience to connect with
So
you to find out more?
PropTex, yep, I appreciate that. It's at www.proptex.com, PROPTEX. We do have an Instagram handle. It's PropTex Funds on Instagram. And we can also go to LinkedIn. You can find me on LinkedIn, get some more information there. But yeah, so, I'm a little old school, Lisa. I've never really been big on social media, although we're
Mhm.
now finally getting there, So I've hired a couple people that are helping me set that up. But, we're a little old school. I like to meet the people that I work with. And the other thing that's unique about us is every single person I work with has my mobile number. So it's not like we're unapproachable or, as opposed to like if you invest in most funds, talking to the actual fund manager is almost impossible. You're going to talk to their assistants or somebody else, right? We make sure that's not the case here.
Okay, perfect. Well, I know my audience likes that. We like personal attention. So those of you listening, please check the show notes. Check it out. Even if you want to get into this type of investment or you're looking to invest house, I know a lot of you take courses on how to be an investor for real estate, but then you don't do anything with it because maybe the knowledge and you don't have the expertise, you don't have the mentorship or the support. So maybe Jay's firm can help you with that so you can start to grow your portfolio and increase your income. Because remember, it doesn't matter how much money you have, it's what you do with it. Hey, mompreneurs, I hope you enjoyed today's episode. If so, please follow the show and share it with a friend who's rebuilding her finances after divorce. No spreadsheets, no restrictive budgets, only confidence to build financial freedom. Also, please drop a quick 5-star review so more moms starting over can find this. It lights me up to know this podcast is helping you. Inhale confidence, exhale scarcity. I'll meet you back on Tuesday for another episode. It doesn't matter how much money you have, it's what you do with it.